Very good morning. Business taxation, unit 2. Hope in the previous unit, that is in the unit 1, you could have studied about the history of tax, canons of taxation, objectives of taxation, importance of taxation, so on. But unit 2 explores particularly into the income tax of individuals, income tax of persons, more specifically. Objective of the session to understand the basic concepts of income tax. So, components of income tax law. Income tax 1961, the act contains the major provisions related to income tax in India. This is what we are going to discuss in the entire session today. And this may continue to the forthcoming session also. The major provisions relating to your income tax in India that we are going to study. Number 2, Income Tax Rules 1962. CBDT is the body which looks after the administration of direct tax. Everybody knows it, right? The Central Board of Direct Taxes is the body which looks after the administration of direct tax. The CBDT is empowered to make rules for carrying out purpose of this act. Third concept, try to understand Finance Act. What is called the Finance Act? Every year, Finance Minister of Government of India presents the budget to the Parliament. Once the finance bill is approved by the Parliament and get clearance from the President of India, it becomes Finance Act. Circulars and notifications. Sometimes the provisions of an act may need clarification, and that clarification usually in the form of circulars and notifications, which has been issued by CBDT from time to time. It includes clarifying the doubt regarding the scope and meaning of the provisions. So, among these four components, the first component is far most important than anything else. That is Income Tax Act 1961. Income Tax Act 1961 is an act to levy, administrate, collect, and recover income tax in India. It came into force from 1st April 1962. Tax is the compulsory financial charge levied by the government on income, commodity, services, activities, or transaction. The word tax is derived from the Latin word taxo. Taxes are the basic source of revenue for the government, which are utilized for the welfare of the people of the country through government policies, provisions, and practices. So, tax is a compulsory financial charge levied by the government on income of the person or commodity, any services, activities, transaction, anything it does. Any activity you do which involves money which attracts taxes. For example, you go and work under somebody as an employee, you get salary, taxable, correct? You do a business, you get some profit, taxable, yes. You sell your property, taxable, yes. You sell goods and services, yes, it is taxable. So either directly or indirectly, the tax is a compulsory charge levied by the government. Okay, what government is doing with your tax amount? All welfare measures across the society have been done because of your tax money. Government hospital, government schools, roads, infrastructure, dams, bridges, everything run through your tax money. So without taxes, no government would survive. Try to understand that. But whether you are enjoying the taxpayer benefit or not, that is non-quantifiable. In majority of cases, the non-taxpayer enjoys everything because they fall under the uh, lower income bracket. So they get freebies and benefits. The part of tax money goes to that also. You travel on the road is laid by the government, you pay the taxes. So this is how the tax money is spent. It ensures the equality across all the classes of the economy. Where is H for income under Income Tax Act 1961? Every income rising to any person will be always classified under one of the following headers provided by the Act. Any income can be classified under these five headings. Income from salary. Number one, income from salaries. So you work under somebody, full-time basis, part-time basis, contract basis, temporary basis, permanent basis, whatsoever. When you get a salary, that is called your income. That can be taken for tax assessment. Clear? You cannot say, sir, it is only my part-time income. That is your income. That's your salary that has to be assessed. But whether you are going to pay tax for that or not, that's a different story. Second one, income from house property. Here, assume that you are house owner of, let us say, 10 houses. If that is the case, you will be enjoying your house rents, right? This house rents are taxable. That is income from house property. Okay. Profit and the gains of business or profession. Profit and the gains of business or profession. You may be doing any business, manufacturing, services, or anything. When you get a profit, it is termed as income. You do a profession, you get a revenue, right? You get a revenue minus expenditure, whatever left is called gain. Correct? Revenue minus expenditure equal to profit or gain. That is again taken for tax assessment. This is one of the head for income under IT Act. Capital gain. Here the scenario is buying and selling of shares. For example, if you gain profit by buying and selling of shares, then that profit part is called capital gain. That capital gain is taken for tax assessment. Income from other sources. Income which is not falling under any of the above categories. Income which is not falling under any of the above four categories. That is called income from other sources. Okay, so recap: income from salaries, income from house property, income from profit or gains of business or profession, income from capital gains, income from other sources. So all the five heads we need to assess to ascertain the taxes. But some heads may or may not be applicable to persons or individuals. If it is not applicable, you just keep nil in the particular section. Income. Income tax is levied on the total income of previous year of every person. To understand the basic concept, it is very important to know the various other concepts. Okay. Income tax is levied on the total income. Okay, total income, that is after deductions. Total income of the previous year of every person. We will see what is previous year, what is assessment year in the next forthcoming slides. In common parlance, income is known as regular periodic return to a person from his activities. You do any activity. As I said in the previous slide, you work for somebody, you do your own business, or you do any professional activity, you sell your property wherever Any economic activity happens, you are paying tax directly or indirectly. That is a different case. Try to understand. Any activity of the human being directly or indirectly attracts tax. However, the income is broader classified in income tax law. The Income Tax Act even take consideration of income which has not risen regularly and periodically. So let us see the different types of income so that you will understand what is income and which income to be taken into assessment. Types of income. Number one, cash or kind. Income tax in terms of cash is not only the way to receive income, it can also be received in terms of any kind. Cash or any goods or services you received instead of cash that is taken into account. For example, you work for a company, let us say for 2 months. After 2 months, they say that instead of salary, you take the brand new laptop from our company. You accept it and you take the laptop. But when you are taking laptop from them, you should receive a letter from them stating that the laptop is given to you for the consideration of work you have done for the company or the services you rendered for the company, and the worth of the laptop is this much. This has to be mentioned, and you need to obtain the original bill of the laptop. If this is the case, this laptop is legally yours and this income can be shown. Otherwise, without bill or without any legal document, the laptop which you are possessing is illegal one. That we will study in the next part. That is legal or illegal income. A man of ordinary prudence may think that illegal income may not be falling under the concept of income. But income tax does not make any distinction between income received from legal or illegal source. Now, I am having a question here. How do the IT authorities know that I have a illegal income? For example, the previous case, the same laptop, if you are taking without the bill or without the letter from the company, just by believing their words, you take it. They are coming to your home. That is the illegal asset. You don't have any source of income for the asset to show. One end, you are telling the company that, see, this is the work I have done for the company, and the other end, the company also should acknowledge this is the work we received from so and so. So we have given the computer or laptop. If that is not the case, you are having the laptop and you are not able to show the source of income for that. That is the legal proof which you don't possess or you don't have. In that case, that laptop value becomes the illegal income. Or let us say your bank account has 15 crore, 20 crore rupees. All of a sudden, it has flooded with funds. You should have the source of income. You could have said that I am the legal heir of so and so, a rich man. After his demise, I have taken all the assets, or all the assets are directed towards me by the court. So I'm having all the valid proof. This money is mine. This is legal money. Illegal money refers to you are having the money or you are having the asset, but you don't have any proof that that asset or money belongs to you. Clear? The concept of cash or kind, legal or illegal income. Okay? Temporary or permanent. As per Income Tax Act, there is no distinction in computing income whether nature is temporary or permanent. So it may be a permanent income, monthly something you are getting, that's called permanent income. Temporary income you get for the first 3 months. You may be a contractual employee. So for 3 months you work, you get 3 months income, that is temporary income. So in the eyes of income tax, there is no permanent and temporary income. Income is a income. If it exceeds certain limit, you pay the tax. That's what their point is all about. So there is no distinction between temporary income and permanent income. Next one, receipt basis or accrual basis. So you studied your financial management, accounting, all those things, right? So you know the basic difference between receipt and accrual. Receipt is something received in the form of cash, or something deposited in the bank in the form of cash. That is receipt. You received it. That is receipt. What is accrual? Accrual refers to the cash or the amount on transit, maybe a check deposited in the bank, or the banker processing your demand draft, anything it may be, or the money is deposited through NEFT and you are yet to receive it. All those things are called accrual. Income arises either on receipt basis or accrual basis. It may accrue to a taxpayer without its actual receipt. So again, there is no classification, receipt or accrual. For both the income, you should pay tax. For example, today it is January 1. Okay. And I assume that by January month bill, I receive by April 1st. For example, if that is the case, that is called accrual bill, correct? My income for the January month I get on April. Let us assume that is a business contract. If that is the case, I need to pay advance tax because the service is rendered in the previous year. The income may be received in the next year. Clear? In which year the service received, that matters. So by March 31st, I need to close everything, right? But as per the agreed terms and condition, only by April I will get the amount. So that amount is called accrual amount. I could have received check from this fellow dated on April 1st and deposited in the bank, so I can show it in my account. Gifts in kind having the fair value maximum up to rupees 50,000 is not liable to tax. However, the whole amount will be taxed if the value exceeds the prescribed limit. Okay, up to 50,000 rupees, there is no tax at all. You can receive any gifts for 50,000 rupees. If the amount exceeds like 50,001 rupees, you are liable to pay the tax for entire amount, that is rupees 50,001. Moreover, the treatment of valuation of gift is different in the different situation, especially gifts received on occasion on marriage. So moreover, the treatment of valuation of gift is different in the different situation, especially gifts received on occasion of marriage. So occasion to occasion, situation to situation, the gift received is treated by the income tax authorities differently. Clear? Types of income again, lump sum or installment. That is a full amount paid at a time or installment amount. The amount may be received as lump sum or installment. Both are taken into account. Lump sum amount, somebody is giving you full payment at a time. For example, you rendered a service and you received payment in full, single shot payment. That is lump sum. Or installment. You rendered some service, but your client is giving your fee or your service amount on installment basis. Let us say he gives the entire amount in 6 months, part by part. That is installment amount. Income tax does not make any distinction in computing whether it received in lump sum or installment. Both are same as per income tax because we are calculating for a year, right? We are calculating for the year. So lump sum or installment. Lump sum or installment. Person. Income tax is levied on total income of previous year of every person. In general terms, the meaning of a person can be interpreted in short term. Whereas, as per section 2, subsection 31, person includes individual, Hindu undivided family, company, a firm, an association of persons, a body of individuals, whether incorporated or not, a local authority, every artificial judicial person. Okay, let us explore one by one. So this concept you should understand: income tax is levied on the total income of the previous year of every person. So this is not about the current year, this is about the previous year income. Okay, what is previous year, what is assessment year, that we'll see in the forthcoming slides. Let us see what is informed in section 2 subsection 31 about a person. It includes an individual. Person means individual. Okay, person means any Hindu undivided family, HUF. Person means any Hindu undivided family, joint family system, where the family head acts as a business head, is called Karta. He decides everything in the business. Okay. The company, a company which is registered under Companies Act 1956, which is registered 1956. Okay, it's a company. A firm, any organization, firm. An association of persons, AOP, an association of persons. It may be a welfare association, something like that. A body of individuals, whether incorporated or not, or a local authority is also a person. A municipal authority, a municipal corporation is also a person. Every artificial judicial person. So all these people are called company, firm. Everybody is known as person as per section 2 subsection 31. Assessee. An assessee, so taxpayer means a person who under the Income Tax Act is subject to pay taxes or any other sum of money as defined under section 2 subsection 7 of the Act. The expression any other sum of money includes other such obligations payable, for instance, fine, interest, penalty, and other tax. Understand the concept. Assessee is a taxpayer, that is, as an employee, as a businessman, as a professional, as a house owner, uh, as a speculator in the stock market. Everybody becomes assessee because they are liable to pay the tax. Assessment year means the year in which the income of the previous year of an assessee is taxed. So assessment year refers to the current year. So in the current year, the income of the previous year of an assessee is taxed. So in the current year, that is the assessment year, in which the income of the previous year of an assessee is taxed. The timed lap of assessment year is 12 months beginning from 1st April every year. The period starts from 1st April of one year and ending on 31st March of next year. Broadly, assessment year is defined under section 2, subsection 9 of the Act. Okay, you know that assessee is a taxpayer, right? So the taxpayer's previous year income is assessed in the assessment year. Assessment year is otherwise called current year. Okay, now we are in July 2020. So this is the assessment year. For example, this is assessment year. Then what is the previous year? That is 1st April 2019 to 31st March 2020. That is the previous year. Clear? Assessment year, previous year concept. Previous year, income earned during the year is taxable in the next year. The definition of previous year is given under section 3 of the Act. Previous year is the year in which income is earned. Previous year is the financial year immediately preceding the relevant assessment year. So previous year refers to the income earned year. So income earned in the current year is taxable in the next year. Clear? The definition of previous year is given under section 3 of the Act. Previous year is the year in which income is earned. Previous year is the financial year immediately preceding the relevant assessment year. So assessment year is the current year, that is 2020 July. Okay. Then immediately preceding year is the previous year. What is that? From 1st April 2019 to 31st March 2020. Hope it is clear. We will move on to next slide. Tax rate. The income is taxed at the rate prescribed by the Relevant Finance Act. So Finance Act we explained already in the slide number 1. The tax levied on the basis of slab system where different tax rates have been directed for different slabs. In India, there are 3 categories of individual taxpayers. An individual below the age of 60 years. They're called citizens. Okay. Then senior citizens above the age of 60 but below the age of 80 years. And third category is the super citizen category, super senior citizen category, above 80 years of age. Again, tax rates vary from one slab rate to another slab rate. Usually, the citizenship slab, that is 60 within 60 years or below 60 years, are paying slightly more than the senior citizens. Senior citizens will be paying the tax slightly more than the super senior citizens. Clear? So we will see the different rates and how it is applicable in the next session. Surcharge. The surcharge is commonly known as tax on tax. It is an additional tax levied on the taxpayers on a special group of people. It is additional tax liability levied on the person having more income than prescribed. Is if the income goes beyond certain limit, surcharge is applicable. Then educational and higher education cess. So this amount is deducted from your tax and spent for education purposes. The amount of income tax shall be increased by an education cess on income tax by 2%, secondary and higher secondary cess by 1% of tax liability. Education cess is explained again from the previous slide. It is replication. The amount of income tax shall be increased by an educational cess on income tax by 2%, secondary and higher secondary cess by 1% of tax liability. So education cess increases your income tax by 2 to 3%. Okay. So let us go for a recap. So we have seen the components of income tax law, that is Income Tax Act 1961, Income Tax Rules 1962, Finance Act, Circular and Notifications. Income Tax Act 1961, what it is, when it is implemented, what is the meaning of that, everything. So various heads for income under Income Tax 1961, income from salaries, income from house property, income from profit and gains of business or profession, income from capital gain, income from other sources. So this slide defines what is income tax and what is income. Types of income: cash or kind, legal or illegal, temporary or permanent, receipt basis or accrual basis, gifts, lump sum or installments, etc. Everything is termed as income. Even your lottery price is termed as income, that is taxable. Person: This slide describes who is called a person: an individual, Hindu undivided family, company, a firm, an association of persons, a body of individuals, a local authority, every artificial judicial person. Assessee. Assessee is a person who pays tax. Assessment year is the current year where the income of the previous year is assessed. Previous year. Previous year is the year in which the income is earned. So the next year it will be assessed. Tax rate. You have seen citizen, senior citizen, super senior citizen. On the basis of their ages, we classify them accordingly. We put them in a different tax brackets. Surcharge is a tax on tax. Education cess, which will increase your income tax up to 3%. Okay. Thanks for your patience and listening. Any question, just to WhatsApp me regarding the subject matter. I'm happy to explain you. Any clarifications if you need, feel free to call or WhatsApp my number. Thanks for attending the session. Stay home, stay safe. Good day.